Good afternoon and welcome to the NAFRA webinar. This is the fourth webinar of the NAFRA webinar series, Thinking Audit, Not Taking Audit. It's my great pleasure to have with me our senior consultant at NAFRA, Mr. Vidyadhar Kulkarni, and we have our eminent speaker for the webinar, CA Achal Jain. As part of this webinar series, on behalf of the executive body of NAFRA, I welcome all of you to this webinar, and this informative webinar on analytical procedures will, through Mr. Achal Jain, will enable us to, enhance our audit practices after the end of the session today. Well, the theme of NAFRA webinar series, Thinking Audit, Not Taking Audit, is to clearly emphasize that auditing is not merely about ticking boxes. It is about providing valuable insights to our stakeholders through identifying risks and its evaluation. Today, we are delighted to have CA Achal Jain. Thank you, Mr. Jain, for joining us, for sparing your valuable time, and for your commitment to sharing your expertise with all our stakeholders. So CA Achal Jain will take us through this webinar on analytical procedures. Well, this webinar serves more than just a platform for sharing information. I urge all the esteemed participants to, actively participate, engage, and ask and raise questions. It presents a chance for us to engage in collective learning and development. I again place on record our sincere gratitude to our executive body and our chairperson for guiding us for the conduct of this webinar. We also hope that through our discussions today, we'll be able to lay the groundwork for audits to transcend mere checkboxes and become strategic instruments that substantially enhance financial transparency and accountability. Together, I invite all of you to embark on this journey of reshaping audit strategies together. I request our senior consultant, Mr. Vidyadhar Kulkarni, to introduce our eminent speaker to all of us today. Thank you.
Thank you, Shyamji. Thank you for organizing this webinar series, and it's at the right time, I must say, because when the entire audit profession is the close to the year end, and so this is the right time, and very importantly, this series talks about the audit documentation, because that's one very interesting and most critical part of audit process and audit requirement, where there is a significant improvement required. So in that context, what you have organized is really great. And just one before I welcome Achal Jain and introduce him, standard caveat of disclaimer: the views expressed here or comments made here, either by the officials of NFRA or the panelists, these are not necessarily the views of the NFRA or its members or the executive body. So with this caveat, I'm very pleased to introduce our panelist today, Achal Jain. He is a chartered accountant, and with more than 17 years of post-qualification experience, and he has previously worked with some of the large audit firms, and extensive experience in audit of large corporations, in various industry sectors like manufacturing, real estate, construction, software, etc. And currently he is practicing and in the specialization in the area of assurance and advisory services, and he has experience of implementing the the high quality financial reporting framework like Ind AS, IFRS framework, and US GAAP. And he has been also a speaker in the trainer on this in the area of Ind AS, IFRS, and US GAAP, many areas. And he has also been contributing a lot in sharing his expertise and knowledge in the area of accounting and auditing. Of course, he's associated with the NFRA training programs, as well as he has been associated with the ICAI's, other committees like Audit and Assurance Standard Board, Accounting Standard Board, and also the Financial Reporting Review Board of that. So he is, contributing a lot there as well. So that's why today I must say that we have a very experienced guest speaker to talk on this topic of analytical review procedures, which are very important critical audit procedures and they have a different phases of audit. They have a usefulness differently, which Achalji will take us through that. So with this brief introduction, Shyamji, now I'll hand over the platform back to you to take the proceedings forward.
Yeah, we straight away request our eminent speaker, Mr. Rachel Jain, to formally, take over the proceedings and start with the discussion and presentation. Mr. Rachel Jain.
Thank you so much, Shyamji Vidyadarji, for this introduction and for giving this opportunity. I would say it's a wonderful initiative of NFRA, and also like you just mentioned that the timing of all of these webinars which has been going on, this is really great because currently we are into a phase wherein some of the auditors must be looking around the audit planning in relation to the audit which they plan to complete for the current year. And during this phase, I think a lot of planning aspect involves some of these knowledge areas. So I'm sure some of these webinars will really help the participants. And today we are going to speak about again a very important topic which is on analytical procedures. This topic, though I'll just try to look at some of the aspects around the auditing standards, but alongside, I'll also try to capture some of the experiences which I have gained during the course of the works around the audit which I have done over the years, and well, also try to share some of the practical insights in terms of some of the challenges, in terms of some of the mistakes that we generally make during the course of our audit. So that is the whole idea of getting into this discussion today. And we'll also like to just touch upon some of the documentation requirement because I believe that's going to be the most critical element as far as some of these training programs are concerned. So I'll just move on first of all to the understanding of this standard or this analytical procedures. And I'll just share the presentation. All right, so now in terms of analytical procedures that we speak about, okay, which is covered through this auditing standard 520, one must understand that this analytical procedure is something which revolves around the complete audit phase. And when I say complete audit phase, we need to understand that this audit broadly can be just segregated into three parts. So one is, of course, the planning phase, wherein we'll plan a lot of areas in terms of the risk assessment, in terms of designing the audit procedures, in terms of materiality, and there are a lot of things which we do. The second stage, we would say, is about the testing, or which we call it as the groundwork, or as the field work. So it's known by different names, wherein we are generally involved in performing the audit procedures. And third is, of course, around the conclusion, basis which then we get on to the reporting requirements. So now, if we talk about all of these phases, I would say that this topic is something which is relevant and required to be involved in all of these phases. So when we talk about planning, in terms of planning, one of the procedures which is required to be performed and which will help the auditor to a great extent will be about the preliminary analytical procedures. In terms of performing the audit procedures, we'll talk about some of the analytical reviews which are done in respect of some of the areas, some of the assertions which become very, very relevant. We'll also talk about substantive analytical procedures as to what's the relevance of that, what's the meaning of that, and how is that required to be used by the auditors. And then once this entire field work, or you can say the performance of audit procedures is concerned, and when we actually get on to the conclusion, even at that point of time, another aspect of this topic, or you can say analytical procedures, is required to be applied, so that the conclusions which are drawn during the in respect of the audit is something which aligns with the overall objective of the audit. And the overall objective of the audit is to just make sure that the financial statements are free from material misstatement. The risk is something which has been taken care of by the auditor. Yeah, so this is something which we need to understand, that this topic is not really limited to a particular phase. It basically flows to all the phases during the course of the audit. So now, what is this analytical procedure? So let's try to understand the meaning of this term first of all. And what do you understand by this analytical procedures? We can say, if you look at the definition which is given by the standard, it's basically about the evaluation of the financial information through the analysis of plausible relationships, wherein both financial as well as non-financial data or the information of the client is involved. So let's try to understand all of these aspects one by one. So what do you mean by evaluation of the financial information? So when we talk about this financial information, so one needs to understand this, or one needs to test the financial statement relationships or the balances which are involved. Then comes the analysis of plausible relationships. Now, in this respect, what is required to be done? An analysis of some of these relationships are required to be done, wherein we'll get on to the understanding. We need to understand as to what can reasonably be expected. Okay, so wherein we draw the expectations as around some of the information which will be available, as around some of the data which will be available. And of course, we need to ensure that all of these information that we are trying to evaluate, that we are trying to analyze, is something which is drawn from the books of accounts, and this is always mapped to the books of accounts of the client. And in this respect, we also need to understand that the information which is going to be analyzed, in respect of which some of these analytical procedures will be performed, is not really required to be financial information all the time. It can always be the non-financial information. For example, if we talk about say sales. Okay, so now sales is a financial information in terms of the sales amount. So if we talk about revenue which has been recorded in the financial statements and which is then required to be audited by the auditor, so this is a financial information. Now what is the non-financial information around it? It could be the quantity. Yeah, it could be the quantity which has been sold. And if we look at some of the other information, for example, material which has been produced in terms of quantity, so this is again a non-financial data. So both these types of data will understand are useful whenever any of these analysis or some of these procedures are required to be performed, and particularly in terms of drawing the expectation, forming the expectation, basis which then we just try to compare as to whether the actual numbers are in line with what is really expected or what should really be there becomes very important. So as we move further, we'll just talk about all of these things in more detail. Now let's try to also understand that when we talk about relationships, okay, or when we talk about analysis of all of these relationships, so what do you mean by these relationships? So we can just take a very simple example. So let's say sale in the previous year was 100 crore, and in the current year the sale is 110 crore. So now in this case we're just trying to compare the two amounts in the financial statements. Now this is something which we are trying to assess, or you can say analyze, through the variance analysis, wherein we are just trying to compare these two amounts. We are just trying to check as to how the number of revenue has really changed. Has it gone up? Has it gone down? And if this has gone up or gone down, so what is the percentage around it? Okay. And we are also trying to look at this relationship, okay, basis some of the expectations that we'll draw, basis the inquiries that we will perform with the management, that whether this number should really go up or it should really go down. For example, so if we talk about this industry, okay, wherein this number has moved from 100 crore to say 110 crore. Let's suppose the industry during the year has been such that there has been a growth of say 10 to 15% during the year. Then we always look at one of those parameters also, that basis that industry analysis or basis that understanding of the industry, whether this variation which we have observed in respect of a particular client is in line with the expectation or not. And if that is in line with the expectation, so it's something wherein we can say that yes, we will draw first level of comfort, or we'll just check that yes, the numbers are in line with the expectations. But at times what we get to see is that some of these relationships or some of these expectations may not really go in line. For example, say during the year there have been some unusual transactions. For example, the company got a new customer in the current year. Okay, so now this new customer is a significant customer for the company in the current year. So in the past years, such a significant sales order was not received. Why? Because this customer was missing. So it's something which has got added. So there is a new event, or you can say this is something which has really changed in terms of the numbers, or in terms of the information, or in terms of the data which was available with the company. So how is it going to impact? So this will create a fluctuation, or you can say it will bring in the variation. And this variation is not something which is going to be usual. Why? Because every now and then you don't get to see that happening. For example, it may happen that during the year the sale has got significantly increased. It has gone up by say 30%. Okay, and the contributor to that happens to be say one of these customers, or maybe there are 5 more customers which have got added and which have really resulted into this increased. Similarly, there could be an accounting change. Now, what do you mean by this accounting change? Say, in the previous year, some of the accounting requirements were there in relation to the accounting of a particular line item. This has changed. Why? Say, for example, a new accounting standard has been introduced. Okay. So last year, the way the leases were recorded in the financial statements was on the basis of the previous standard. Okay. Now let's suppose the new requirements in respect of accounting of leases has been introduced. So what will happen? It will create a fluctuation. Okay. And again, that will depend on the accounting requirements which will be there in that particular accounting standard, whether that require comparatives to be changed or not, or maybe some sort of exemptions or reliefs are available over there. But this is again something which can bring in a change. Now, similarly, there could be a lot of such factors which can always bring in those variations, and which are not something which are going to be usual every time. So all of those factors are at every point of time required to be looked at. And one more important aspect which definitely should be touched upon could be about the misstatements. Now, what do you mean by misstatements? Misstatement simply means the errors. Okay, so if there is an error in the financial statement, so what do you call it as? It's a misstatement. Okay, now can this error bring in a variation? Of course, yes. Yeah. Why? Because through that error, the variation which should have been there is not really what it actually looks like. So these are some of the reasons which can always bring in some of these things at various point of time. So now, as we discussed that this procedure around analytical review or analytical procedures is something which is required to be looked at various points of time in the planning phase, in the phase when we are actually performing the audit procedures, and of course in the conclusion phase. Now, as we all understand that all of these auditing standards are quite interlinked, okay, and audit is again an activity which requires a lot of procedures or a lot of areas to be looked at simultaneously. Yeah, so similarly what you get to see even in this particular auditing standard, so when we talk about analytical procedures, so it's something which flows from SA 520, but even in this standard we can see the references of the risk assessment, say SA 315, wherein we talk about that SA 315 discusses the risk assessment and wherein it requires this preliminary analytical procedures again to be looked at. Similarly, if we look at another auditing standard, say SA 330, that again talks about some of the responses which the auditor will plan around those assessed risk and which could be in the form of some of the procedures which are going to be around the analytical procedures. Okay, so all of these things now we are going to look at one by one. So I'll just start my discussion with this preliminary analytical review. I would say this is generally not performed by some of the auditors in its true sense, but one must understand that this happens to be one of the most important area in terms of the planning as around the audit. Now, whenever an audit has to be planned, so what is it that we are trying to look at? We are trying to look at the risk factors. We are trying to look at the risk factors, some of the significant items which could be there in the financial statements. What are going to be the significant risk areas? What are not going to be the significant risk areas? Basis which, what will the auditor do? Auditor will decide the audit procedures. Basically, auditor is planning to look at the audit procedures which he is going to perform on. Okay. Now, as around this aspect, this preliminary analytical review becomes extremely important. So now, what do you do in case of a preliminary analytical review? So let's try to understand that. Now, as we discussed, that we are in a stage when we are planning the audit work. Okay, so we are basically planning the audit. So that means we don't have the access to each and every information which is going to be there when the field work will start. Yeah. So now, in respect of this planning, what is going to be the information which the auditor will have? So auditor will have the access to the last year's files. So let's suppose it's a continuing audit. So he will have access to the last year's files. He will have information as around the audit of the last year's financial statements. Then he will have uh, done first level of discussion with the management. He will also have a draft trial balance, or in some cases he may also have the draft financial statements of the company, or even if not the full financial statements, in some of the cases the draft balance sheet, the draft statement of profit and loss. Yeah, so some of these things are going to be available with the auditor. Now, as around some of these areas, let's try to understand as to what do you do. Now, as a first step, in terms of the preliminary analytical review, what is it that the auditor needs to look at? He needs to look at that on the basis of the draft numbers or this first cut. Yeah, so again, this is known by different names. What is the variance, or is there anything which the auditor needs to look into? Okay, for example, say auditor is looking at the statement of profit and loss in the current year, and it's a draft statement of profit and loss which has been made available to him. Okay, and he has not really started the audit, he is looking at the planning. So in the statement of profit and loss, what does he see? He can see that the finance cost has gone down significantly. Okay, so let's suppose this has gone down by 90%. Now, how will he get to know about it? So one, he's looking at the statement of P&L, and in the statement of P&L, he's doing a comparison. He's comparing the numbers of the current year with the previous year. Okay, which is also called as variance analysis in some of the cases. Yeah. Now, on the basis of this analysis, now how will the auditor assess this? Now, immediately he will understand that either the borrowings have gone down, maybe the borrowings have been repaid during, have been paid during the year, and that's why this finance cost may have gone down significantly, or maybe there is some sort of restructuring which might have taken place, which again may have some accounting implications, or the auditor or the audit implications in respect of that, or maybe that there is an error at the first level of this financial statements which has been made available to the auditor. Okay. Now, how will it help the auditor? Now, when the auditor will be planning the audit procedures, now he will be able to focus on this item a bit more as compared to some of the other items, which could be in line with the trends which could have been there in the previous years. And how will he get to understand about it? Only when he will do this sort of analysis, or you can say he will do this review, wherein he will compare the data of the current year with the previous year. Okay, and this is going to be a very simple exercise, but this can throw a lot of information, a lot of areas for the auditor to focus on, and which becomes again important on the part of the auditor to look at. So that's why this first stage, or this planning stage, involves one level of the analytical procedures, and that is what we call as preliminary analytical review. Now, this will help the auditor in terms of designing the audit procedures in some sense. Secondly, if we talk about the planning, now as regards the planning, I think the most important aspect of audit happens to be the understanding of the entity, understanding of its business, understanding of some of the processes which are there in the business. Yeah. And of course, understanding of the industry. Now, all of these things can be done by the auditor basis the discussions with the management. And of course, in the planning phase, some sort of discussion will take place. He will perform inquiries with the management. So all of these things will happen. But this understanding can further be improved if the auditor will perform this preliminary analytical review. Why? Because we just looked at on by taking that example of finance cost. Okay, so let's suppose if the auditor doesn't look at it, if he doesn't look at that variance analysis, he may not be able to draw that conclusion, or he may not be able to come across that change which might have taken place. But now when he looks at that particular information, looks at that fluctuation, he can go and ask the management, okay, as to the reasons around it. It may be an error which could be there in the financial statements, or maybe there is no error in the financial statements. It could be either way, but this becomes important for the auditor to look at all of these things. Yeah. Now, let's understand some of the considerations. Now, in terms of the considerations, as we have been discussing, auditor will not really limit himself to the financial information. He will also be looking at non-financial information. So for example, he may want to look at the production data, which may be available to him. But as around the information which is required to be looked at a preliminary level happens to be this high level analysis. So auditor is not getting into into each and every information in detail. So he's not getting deep dive. Yeah. So he's just looking at the information at a high level. So he's just comparing the numbers of the balance sheet. He's just comparing the numbers of the P&L. So all of these comparisons he has been doing. Yeah. And what is the whole idea? The whole idea for the auditor is to just look at the risk assessment, or maybe some of the things that he would want to add to his risk assessment. And of course, idea is to draw the audit procedures around it. So now let's try to also understand that during this phase, what sort of analytical procedures should the auditor generally perform? So should it be a trend analysis? Trend analysis means he can just look at the trend of the previous years as to how the numbers have been changing. Or should it be a ratio analysis? Now, what do you mean by ratio analysis? So it could be about checking the net profit ratio, comparing that with the previous year, GP ratio, comparing that with the previous year. Or should it be a reasonableness test, which could be about the checking of the depreciation as to drawing the expectation around the depreciation and how the number has actually come out in the financial statements? Or should it be all of these? Now, like we understand, and as we understand that during this phase, what is available to the auditor? It's a limited information which is available to the auditor. And in this case, he is also doing the analysis at a higher level. He is not getting deep down into each and every information. So that's why one sort of analysis in terms of the analytical procedures around this reasonableness test may not be appropriate at this stage. So that's why what is going to be the most appropriate in terms of the procedures that he is planning to, or he should really be planning to apply, that should be around the trend analysis or the ratio analysis. Now, as around the trend analysis, as around this ratio analysis, let's try to understand as to what is he going to do. Like we discussed, in case of trend analysis, he'll just analyze as to how the numbers have been changing year on year, or maybe the month on month analysis of the sales he may do, prior period balances as to what have been the numbers in the previous year and how they have been changing. For this ratio analysis, we discussed this GP ratio, their NP ratio. There are a lot of KPIs that he can look at, and he can just evaluate, or he can just compare as to how those have been changing, on the basis of which he will be looking at the audit procedures. So let's understand some of the situations and how the analysis of some of those situations during this planning phase through this preliminary analytical reviews that he will perform is going to have an impact on the risk assessment and basically on the audit procedures. So let's suppose if he finds that there is a closure of business location, and how will he get to see this? In the financial statements. Okay, so there is a discontinuing operation. Yeah. So, or maybe some information which he comes across on the basis of discussions with the management. So this could be an indicator of impairment. Yeah. So let's suppose there's a change in the product line. Yeah. So this is what he has understood on the basis of the analysis of inventory, on the basis of this cost of goods sold, which he has compared. So maybe there's some obsolete inventory, yeah, which is required to be looked at in terms of the risk assessment. So if he finds that the debt collection ratio has been slower as compared to the previous years, so now this is going to have an impact on the provisioning requirements, yeah, which he is going to look at as part of his audit procedures. Yeah. So some of these factors become very important, as you can also see that they may have an impact on the risk assessment, and something which is going to impact on the risk side is going to remain valid throughout the course of the audit and in respect of all the audit procedures which are going to be performed. Now, what I will just want to do is I'll just also like to take you through some of the working files, okay, so that we can also get a feeler as to how this preliminary analytical review should really look like. So what I've just tried to do is I've just tried to put down some information in the form of a kind of work paper. I won't really say it's a full-blown work paper, and we'll just try to see as to how this preliminary analytical review should really be drawn by the auditor. Okay, so let me just share this working file with you. All right, so as you can see, statement of profit and loss, okay, and all of these numbers are drafts, so there's nothing specific which is involved, and this work paper, I won't really say is this the final stage. Okay, so this is again something which we need to analyze, or we need to look at as to how this preliminary analytical review should really look like. So let's suppose if we look at this revenue, so you can say it's a draft P&L which has been made available, and we have only two sheets. Okay, one is the P&L and one is the balance sheet. So only these two sheets have been made available. So what is it that the auditor will do? So he'll just put down these two numbers. He will just compute the variation in between these two amounts. Okay, so the amounts are in lakhs. Okay, and then he will also compute variation in terms of the percentage as to how this number has really changed. Now, what does he find? He finds that revenue has changed by 2%. Okay, so this has gone down by 2%. Now, in this case, considering that revenue is a significant area, okay, he will definitely want to inquire with the from the management. He will also want to look at as to some of the factors which may have caused this shortfall or this decline in the current year. Now, there are ways to look at it. In some of the cases, the auditor may also build an expectation. He can also set a number or set a threshold beyond or below which he may not want to get further or get into some of the details of understanding as to how that change is going to impact his audit procedures. But in some of the key areas, he may still want to get into some of these details a bit more. So, for example, herein he is documenting that on the basis of discussion with the client, variation is because of termination of sales order during the year. Okay, so in the month of March, some of the sales orders got terminated, so some of the sales got reduced. Okay, and he is also saying that decline in sales is due to a loss in demand in the market due to a particular sector. So maybe this client is catering to a lot of sectors, but in this particular sector, the demand has gone down. Now, this is what he needs to understand and he needs to analyze. So, how will he do this? When he will make this comparison. So, similarly, he may do this for each and every line item which is there in the statement of P&L, statement of this balance sheet, and he will have to put down this reasoning as to why the numbers have been increasing or decreasing, and on the basis of which then he would also want to design his audit procedures, okay, which he can just put down in a separate file, or maybe he can just put down in this file itself. Yeah, so it may be either way which he wants to follow. Now, all of these procedures or all of these things which he's going to do, now what do you call it as? This is something which will become the documentation. Yeah, now this aspect is something which we need to understand. So a lot of times an audit team may be performing this audit procedure, okay, so they may be doing this variance analysis, they may be performing all of these preliminary analytical procedures, but they may not be documenting it. Now, if that is not documented, so is it really going to serve our purpose? The answer is no. Why? Because later on, there's no real evidence in terms of whether this audit procedure was really performed by the auditor or not. Similarly, I flip through these balance sheet items also. Now, in terms of balance sheet also, he'll just put down the numbers, he'll just draw the variation, and some of these items may not really be looked at on the basis of variance analysis always. Why? Because variance analysis in some of the line items may be relevant, in some of the line items may not be relevant, but it is going to give a first level of indication to the auditor and first level of understanding to the auditor. Okay, so now I'll just move back to my presentation. Okay, so now moving on to the next stage. Now, after this preliminary analytical review, the next stage, which becomes relevant for the purposes of audit, and I would say which is extremely important for the purposes of audit, happens to be substantive analytical procedures. Now, as we understand, so it's not only about analytical procedures, so it talks about substantive analytical procedures. Now, why is it required to be done? First of all, see, on the basis of the analytical procedures, what is the objective? Objective is to obtain relevant and reliable audit evidence. Okay. And in relation to a particular assertion, in relation to a particular account balance, in relation to a particular class of transaction. So that is going to be the whole objective. Now, what do you mean by substantive analytical procedures, and what sort of considerations that you would want to give on the basis of which you will want to perform this analytical procedure? See, let's try to understand about this substantive analytical procedure first. Say, for example, in the current year, what do you find? In the current year, we say that the employee cost has increased. Okay, now the employee cost has increased. Fine. So, what is the analytical procedure will do? We'll just, let's suppose, draw a comparison. So what do you find? That the employee cost has increased by say 15% during the year. Okay. Now, once this comparison has been done, this variation has been looked at, auditor will go discuss this with the management. Auditor will also speak to the HR team, because it becomes important that auditor doesn't only talk to the accounts or the finance team, he also goes to the non-finance personnel. Okay, so who can give him the best insight as around some of the activities or the transactions which may be taking place within the organization. Now, when he goes and meets the HR head or maybe the HR team or the accounts team, what does he understand? That this employee cost has increased. Why? Because during the year there has been an increment. Okay, increment to the tune of say around 15%, and that's why this cost has increased. Now, can we say that on the basis of just this inquiry, this procedure is considered as done? The answer is no. So now, as around this procedure which has been performed by the auditor, wherein he is also looking at all of these analysis, and he's discussing all of these items with the management, he also needs to corroborate this. Now, once he has discussed this with the management, he also needs to corroborate this with some document or with some information which is available. So now, what could be the information which may help the auditor in terms of corroborating this point? Maybe the increment letter on a sample basis. So it's not about performing the test of detail in a complete manner. So we can say one sort of procedure which is around the test of detail, which the auditor will do at the time of substantive testing, is required to be applied alongside the analytical procedures that auditor will perform. Okay, so now when he will understand all of these things, and this understanding is then corroborated, let's suppose with this document in respect of some of the employees which are there, and which demonstrate that yes, during the year this much increment has taken place. So what will happen? So this will give a great level of comfort to the auditor, that yes, something which he has really understood from the management is in line with what should actually be there. Secondly, as around these analytical procedures, the other important aspect is around the expectations. Now, during this phase, or you can say as around this phase when the audit procedures are being performed, auditor may not really limit himself to the ratio analysis or the trend analysis. He now also needs to get on to the reasonableness test. Okay, for example, he can draw the expectation. And how will he draw the expectation? So let's suppose he looks at the head count of the employees. So last year, the head count, let's suppose, was 500. So now he can look at the head count for the current year. So let's suppose in the current year, the head count has remained largely same. So it's 505 employees. Okay, so no significant change. So now in the last year, he can then look at the average salary per head count. And he can then compare this with the average salary per head count. So now basis this, what will happen? He will draw an expectation that on the basis of the head count which was there in the last year, what should have been the salary for the current year? And is that salary, or this is that per head count salary, in line with the actual numbers which are there? If those are in line with the actual numbers, then of course, this is something which he can look at, and which he can then further corroborate basis the documents or the information or some of the information which we have already obtained through some other audit procedures, which could be around the test of details. The other aspect is that during the course of audit, this control testing, okay, though this is something which is a separate topic altogether, but it's something relevant in the context of analytical procedures, is also going to play an important role. Why? Because let's think of an organization wherein the test of controls have been performed and the controls have been found to be operating effectively. Now, in this case, what will happen? The comfort of the auditor will definitely increase. Yeah. And if the comfort will increase, then there are going to be a lot of areas as around which even these analytical procedures are going to help the auditor, and basis which he can just cut down on the test of details. Yeah, but as compared to that, if let's suppose we talk about a company wherein the control procedures are not, so wherein the control procedures have been performed, but the controls have not been found to be operating effectively. So in that case, the comfort level will go down, wherein he will definitely want to perform the audit procedures, but along the audit procedures, as around the analytics which the auditor will perform, he may want to perform more on the test of details. Yeah, so all of these factors are required to be looked at. Another point as around the analytical procedures is in respect of some of the account balances as well as some of the assertions. So let's try to understand that. See, analytical procedures could really be helpful in relation to a particular assertion. For example, say if we talk about revenue for a company, a very critical area in relation to the financial statements. Now, in relation to the revenue of the company, let's suppose it's a large company and the sales transactions have been running into lakhs. So during the year, there have been lakhs of transactions. Okay. Now, as around this, now in terms of the assertion around the completeness, so if we perform the test of detail, so can it really give the auditor the complete comfort around the sales number? The answer to that may be no. So let's suppose if we perform this test of control, can it once again give the complete comfort? Again, this will help the auditor, but we can't really say that this will help the auditor as around the completeness in terms of the assertion which he is going to look at. But there is one procedure which is analytical procedure, which along with these two procedures, so when we perform test of control, test of detail, and then we perform analytical procedure, can help the auditor. For example, let's suppose during the year the turnover has been 5,000 crore. Okay, and the last year the turnover was say 4,500 crore. Now this change, let's suppose test of control has been performed, controls are operating effectively, test of details have been performed, sample testing, all of these things have been done, and there have not been any material errors which have been observed by the auditor. Now the auditor looks at this complete population, he draws the expectation, he looks at this rate analysis in terms of the reviews, he looks at the trend analysis, he looks at the ratio analysis, he also looks at this variance analysis, on the basis of which he can then get a comfort over this complete population. Yeah, so this will help the auditor to a great extent in terms of coming to a conclusion as around some of these line items which otherwise are not possible. Yeah. Now let's look at some of the line items wherein some of these analytical procedures may not really help us. For example, if we talk about say a particular expenditure, say in case of a company, uh, printing and stationery. Okay, so it's an administrative expense. Now, if we perform any procedure as around this printing and stationery, what could that procedure be? It could be around the controls in relation to the operating or the in operating expenses, or it could be the test of detail which could be there. But as around the analytical procedure, so let's suppose if we do variance analysis, if we want to perform any sort of this expectation creation, so will that be possible in such a case? The answer to that may be no. Yeah, so that's why once again the auditor needs to look at some of the line items which are there in the financial statements, to which some of these procedures are going to help him to a great extent, and some of these procedures are not really going to help him much. So wherein he will have to rely more on other audit procedures as compared to some of these analytical procedures. Now, as around this corroborating evidence, so if we look at some of the examples around it, so auditor can look at the supporting evidence, he can always look at the information which he may have obtained during the course of the other audit procedures he may have done, and of course on the basis of inquiries which he may have performed. Now let's look at this example. Now, which now in relation to uh, this depreciation reasonableness test. which procedure out of these do you think is going to be the most appropriate? Will it be this comparison of depreciation expense as a percentage of average amount of PP? Second scenario is when the auditor look at this average amount of PP on a class basis, which is then looked at as a percentage, or which is then looked at this useful life, which is compared to the depreciation expense. Or if we look at this option number C, which out of these one can say is really going to be the most appropriate? So one may say that it's the B1. Why? Because in this case, the information which the auditor will look at, the level of analysis which he would want to do is going to be more precise. Because in other options, if you'll see, the information is not going to be so precise. The analysis which he is going to do, the outcome is not going to be so precise. Now, what are going to be the final steps as around these corroborating evidence or as around these substantive analytical procedures? One, of course, is to document the explanations plus how they were corroborated. Okay, and this needs to be this needs to be documented within that particular work paper in respect of which substantive analytical procedure has been performed. So auditor should not think that yes, this testing has been done, maybe let's suppose in test of detail this has been documented, but this will now be documented when this analytical procedure has been performed. Okay, so let's suppose COX analysis has been done. Now in terms of COX analysis, some testing was done, say in a different work paper. So at least some reference to that work paper should be drawn so that this can really be demonstrated that this has also been done by the auditor. If the explanations aren't reasonable or can't be corroborated, so what is going to be the next step? Of course, the auditor will have to go beyond these audit procedures. We cannot say that these are going to be the conclusive audit procedures. So there are a lot of other audit procedures which is going to look at. Reviewers must make sure that the explanations are corroborated. Why? Because it's important. Just on the basis of inquiries, just on the basis of analysis, or maybe if there were some expectations and those are just matching the actual numbers, cannot be the only procedure. So this corroboration, okay, means looking at the information on a sample basis is extremely important. Why? Because only then auditor will or he can say that yes, the analysis which he has done, the understanding which he has obtained is in line with the actual information or the actual transaction or the actual activity which has taken place. Yeah, so these are, I would say, some of the very, very important areas for the auditor to look into. Now, what we can do is before I move on to the next stage, I'll just again take you through one of the work paper, or you can say a kind of work paper. We'll just try to see as to how that should really be documented by the auditor. So I'll just once again take you to a separate file. And in this file, again, we'll just try to assess as to how this particular documentation should be captured. As we discussed that the whole intent of this kind of work paper, I won't really say it's a full-blown work paper, is to get a feeler as to how this documentation should really be done, wherein some sort of linking or some sort of audit procedures are what we are going to discuss. Okay, so now there could be different nomenclatures to some of these items that we are looking at. So you should not think that these are the only nomenclatures which are possible in respect of a work paper. So these can keep changing. The whole objective needs to be looked at. Okay, so maybe this is the summary file wherein the references of some of these work papers, wherein some of these areas which have been tested. So month on month analysis on revenue has been performed. The top 5 customers were looked at, and in respect of those top 5 customers, thus analysis were performed. Maybe the product wise analysis as around the revenue was performed. So all of these things have been documented in a single file. And because it's a single file, so this summarized information has also been captured over here. Then on this particular sheet, the work done has been documented. So what all procedures the auditor has performed in relation to some of these activities which are there. Then the next step is, so if we look at, just give me a minute. So if we look at these top 5 customers, now there are again ways through which this documentation could be done. So work done has been given. Okay. So similarly, the objective could also be specified. Okay. And the period for which this audit has taken place, or this audit has been taking place. So all of these things can also be kept. Then in most of the cases now, the audit firms use the audit softwares, or in some of the cases when the softwares are not used, there are some, you can say, a sort of tick mark which is created. So what are these tick marks? So maybe you can say these are the references, that if a particular tick mark will be given, so what does it mean? So maybe a particular symbol has been created, so every time that symbol will be used, it means that this information has been ticked to the sales register. Okay, so let's suppose a symbol has been created which is around the recomputation. So that tick mark will demonstrate that this amount was recomputed by the auditor. So it's not only the management number, it's the auditor also who has done this recomputation. Similarly, so if there is some item, or there is some number, or there is some analysis which he has drawn, and that is found to be below materiality level or below scope, depending on again what all have been planned by the audit team, so this again can be put down in the form of a symbol. So there are again ways to document it, but this is generally how you get to see this. Now, these are the top 5 customers, let's suppose. So AXY, LKP. Now, in relation to 2 years, their revenues have been compared. Okay, so it appears as if the years are not visible right now. So let's suppose you can say that this is current year, and let's suppose this is previous year. Yeah. So this is then compared. And after that, what has happened? Now, in relation to these top 5 customers, one, the information of revenue has been segregated. Now, this revenue has been split basis the customers. Okay, top 5 customers. Now, again, it's not necessary that it will always be top 5, or it will be top 10 or 25. So this needs to be looked at as around the coverage which the audit team will plan. And then in respect of this revenue, let's understand as to what all procedures they have been performing. So they are comparing the quantity. So a quantitative variance has been drawn, a rate variance has been drawn, and the amount variance has been drawn. So generally, what do you get to see in the file? Maybe the amounts have been compared, and that's it. So an analysis which would involve the customer categories, and which is then further put down, or you can say broken down on the basis of quantity as well as the rate, which is going to give a more detailed analysis, and the conclusions basis which will be drawn by the auditor, you can understand, okay, they are going to be more helpful. Now, as around this, at every point of time, what should be the first step? So every time an information is received, the first step should be to check whether that number is tracing to the trial balance or the books of accounts or not. So let's suppose this is the sales number. Yeah. So let's suppose this is the sales number. Now, does this number tie to the books of accounts or not? Now, generally, what do you find? That the moment we get the information, we'll just simply start applying the audit procedure. Maybe later on we get to know that some of these information that we have received is not complete, or may have some errors. So is that appropriate? No. So the first step should be what? To trace that information to the books of accounts, and then start applying the audit procedure. Now, similarly, what could be the next way? To put down this information on the basis of various products and then compare it. Okay. Now, here again, the auditor may define scope. So you can just look at the scope. So he's saying that if there's a variance of plus or minus 5%, that has only been inquired into. So maybe he didn't go beyond that. Why? Because that was within his permissible range. And what will bring the auditor to that permissible range? That is going to be his planning, or his risk assessment, or his materiality level. Yeah. So all of those factors will have to be looked into. So now these are some of the products. Now, as around these products, what do you find? That the information of revenue has been put down into domestic and export, Then on the basis of these products, then all of these information has further been broken down into quantity, rate, and amount. So see the level of analysis which has been performed plus which has also been documented. Now this becomes important. Yeah, so all of these procedures we may be doing, but we may not be documenting. And over here, all of these remarks are required to be captured. So you may be thinking that this is blank, but this is something for your purposes for you to look into. Yeah, wherein you can always give the reference of separate work papers. So you remember we discussed that there could be some information which may have been received by the auditor on the basis of a particular procedure which he may have done. So he can always give the reference over here. So you can say over here, he can give the work paper reference. Okay, so this is how he can just put down the information. So similarly, there are a whole lot of audit procedures which he may perform as around the analytical procedures as well. So this is something which he needs to look into. Yeah, so now moving on to the next stage, and I would say the most critical stage, that is about the conclusion stage. Okay, so now what has happened? So the auditor's planning is done. So it's sort of completed. Conclusion, the procedures are also performed. Yeah, so all of the substantive testing, field work, each and everything has been completed. Now, auditor is moving to a stage wherein he will start drawing conclusions. Now, at this particular stage, once again, what is required to be done? Once again, one final level of analytical review is required to be performed by the auditor. So, how is it going to help the auditor? This will assist the auditor in forming an overall conclusion as to whether the financial statements which have now been drawn, okay, after completing this field work, after completing this substantive testing, are consistent. Now, this is important, are consistent with the auditor's understanding of the entity. See, now the auditor has spent a lot of time on audit. So he must have drawn the understanding around various classes of transactions, yeah, around various account balances, around the significant risk areas, around a lot of line items which are there in the financial statements. So now what is it that he's just trying to do? He's looking at the final financial statements and he's just trying to check that now are the numbers falling in line the way he has understood, the way he has really applied his audit procedures or not. Yeah, so that's why this stage becomes again very important, and this should not be ignored. So we should not think, oh, it's all done and closed, so that's why let's get done away with this. No, so this again become very important, and this may help the auditor identify a previously unrecognized risk of material statement. So let's suppose during the planning stage, when the draft numbers were made available, so maybe some of the items were not captured by the auditor. Why? Because in his review or during the course of his planning, some of the items he was not able to focus much on. Let's suppose during the course of substantive testing, once again, auditor has got limitations as around the audit procedures. Some of the items on which he has performed the audit procedures on could not throw some misstatement. But finally, the final set of this financial statement, which is now made available to the auditor and which is now going to be finalized, when he again look at that, when he starts comparing the numbers, he starts doing all of these analytical procedures on this final set, he may come across some of the line items which he may have overlooked, okay, or which was not really focused upon by him, and which may have some material misstatement, and which becomes important on the part of the auditor to look at. So that's why this again becomes important activity. Now comes the question that during this phase, okay, so we are in the conclusion stage, what sort of analytical procedures should the auditor really perform? Okay, so should it be a trend analysis, something we looked at in case of preliminary review? Should it be a ratio analysis, or should it be a combination of all of these three, wherein this reasonableness test, which we found to be most appropriate in relation to substantive audit procedure, should again be captured? Yeah, so what is going to be the most appropriate as around this stage. See, now once again we have got into a stage where we are not looking at the information in terms of its detailed review, or you can say we are not again getting deep dive into that information. Why? Because that set of audit procedure, that level of procedures, that level of activity has already been done by the auditor. Okay, so he's done with that part, he's done with that aspect. Now once again, something which he did in case of his preliminary analytical review at that level, or you can say a slightly more advanced version. Why? Because the information is more precise, the information is more accurate, and it's sort of final. So that's why it's again going to be the trend analysis and the ratio analysis. So now he's not going to get into this reasonableness test at this stage of, yeah. Now, some of the considerations, as we discussed, that what are going to be the considerations. So he will do a high level analytics at this stage, wherein all of these trend analysis, ratio analysis, etc. is going to look at. No corroborating evidence is required at this stage. Why? Because this has already been done. So we are not saying that he should start repeating his audit procedure. Why? This is already done. So he is not required to get into that. Yeah, but if he comes across any error, if he comes across any material misstatement, or if he comes across any area which he believes is now important, on which some of the audit procedures which should have been performed have not been performed, then what is going to happen? Then he will have to apply audit procedures in respect of that area also. So we are not saying in any ways that at this stage auditor cannot perform any audit procedure. The idea is that this doesn't require auditor, but if he believes there is a need which has arisen because of the errors or because of the misstatements which are there, he may definitely want to get into that stage also. But one must understand the fact that this is going to be a final level of review. So that's why you can say it's a sort of last opportunity for the auditor to really get into this aspect. Yeah. So what I'll once again do is I'll just take you to one of the working file as around this overall analytics also, as to how this overall analytics should really look like, or this final analytical review should really look like. So let me just sort of get into that work paper also. So this was more of a skeleton, I would say, which I've just put down over here. But idea was to just give you a feeler as to how the final analysis is required to be done by the auditor. So if we look at the statement of profit and loss, so what is it that the auditor will do? Once again, he'll just put down the information for 2 years. So current year is 31st March 24 and 23, as we discussed that this is without numbers. He will draw down the variances. Then he will also check whether the variances are usual or unusual, which he can always do in other stages also. He will put down the explanation, and he will also give the work paper reference. Yeah, why the work paper reference is important? Why? Because in respect of all of these areas, auditor has already performed the audit procedures. Yeah. So this, you can say, is going to be a high level analysis, but which can capture this entire gamut of this audit activities he may have performed. Yeah. So all of these things are in a way put down in the form of this analysis which the auditor is going to look at. Yeah. So this is required to be done at the level of statement of profit and loss. Similarly for balance sheet, all of these analysis he will perform, and basis which if he comes across something which is unusual, or something which is not in line with what he has expected, or what he believed should be there in the form of a financial statement, he is then going to talk about, or he is then going to discuss or take up that particular line item also. So I think with this we can just conclude our discussion. So this area is quite important. So that's why if this is really applied in its true sense, one will really achieve a lot of objectives out of it. So with this, I'd just like to conclude my discussion, and thanks to everyone for your time. And I think we can now move on to some of the questions, doubts. Happy to have your questions now.
Yeah, what a fantastic way to take us through the analytical procedures, right from the preliminary stages of analytical review then explaining about the substantive analytical procedure and the conclusion part of. We are very happy, and it was pretty interesting that you shared practical examples and the work papers as well. So, CA Achaljan, I think we have a couple of questions from our esteemed participants. So, one of the participants would like to know some examples of accounting change.
Perhaps what he means is, I think, as you mentioned earlier, some accounting standards, etc., change. Because of that, some numbers might change. So, some examples of such, one should really, auditor probably consider in
Yes.
doing his analytical review procedures.
Yes. Yes. So you can say, for example, if we talk about leases standard, okay. So earlier on leases, we did not have Ind AS 116. Now this Ind AS 116 is all settled, okay.
Yeah.
And if we look at this leases standard in particular, this also gives you some sort of relief in terms of whether you really apply that to the comparative year or not. Okay. So if let's suppose that is not really applied to the comparative year, so your numbers are going to change. Okay.
Yeah.
When these numbers will be compared to the previous years. So now why is this change taking place? This is taking place because of the accounting. So when you will draw the comparison, when you will perform your analytics, so you'll understand that this change has resulted because of the change in accounting. Yeah. And this change in accounting could also be there. Maybe the management thought that in the last year there was some inappropriate accounting practices, or maybe there was some misstatements, yeah, which have not been taken care of by the management and which have now been captured. Yeah. So there are reasons because of which such changes may arise.
Maybe, Achal, if I may just add a little bit. Say, very rightly you gave this 116 very good example of change in accounting standard, and which will lead to some change in numbers. So the auditor is likely to expect that there will be some change in numbers. Say, for example, because of this Ind AS 116, for example, earlier the operating leases were treated as rental charges, lease rentals. So that number is to be there. And when it comes to the new Ind 116, then everything will get accounted as your asset, and then depreciation charge will be there, and on the liability side, interest expense will come. So one should probably expect in that scenario that the because of India's 116, the lease rentals are likely to come down. And if they are not come down, one should really look at is it short-term lease exemption, etc., which they have taken, or why this has not come down. And simultaneously, you should have been expecting that the depreciation charge should go up. If that has not happened, then it is in the preliminary analytical review stage, you can look at something like this and see that use this kind of accounting change to ensure that basically end of the day, by doing this, you will ensure that the Ind AS 116 has been applied correctly or not in the current year. Yeah.
Right. And just to add to your point, so there could also be other way around. For example, a change is required. This has been introduced, but the company has not really looked into it. Okay, so this accounting change has not been incorporated by the company in their financial statements. But now,
Yeah.
when the auditor is looking at the financial statement, one, he doesn't find any disclosure around it. He doesn't find any change which should have been there. So
Yeah.
he will then look into this, sort of assessment which he would do, that why this change has not taken place. He'll discuss, or you can say he will get this rectified. So this
Yeah.
could be both ways there in
Yeah.
the financial statements.
Okay, so can you please give us some examples of what could be some common, analytical procedures in the audit area of inventory valuation?
See, in terms of inventory valuation, one of course will be around the variance analysis, which you will want to do. Then around the inventory, like we discussed in case of revenue, you will always want to break it down on the basis of quantity, on the basis of rate, on the basis of amount, and then you will want to compare it period on period, depending on as to whether the quantity has been changing, whether there has been any change in the cost component. And how will you get to know about the cost component? Because let's suppose you have some X quantity, okay, basis which, let's suppose sum is your amount. Now whether this amount has increased or decreased because the rate has gone up or rate has gone down. Now what do you mean by this rate? The rate is all about the cost of the inventory. So this again is going to be your analysis. Now on the basis of this analysis, then you will also be able to look at some of the cost components. Now inventory is required to be looked at in terms of what all costs can be forming part of the inventory. Yeah, so there could be some direct cost, there could be some directly attributable cost. So this is again required to be looked at. Then the other part could be that this split can be done on the basis of some of the products. So let's suppose company is dealing into only 3 products. So they can always break down this information on the basis of products. This again can be broken down on the basis of the vendors. So let's suppose company has got some top 5 vendors. So on the basis of those vendors, this split can be done. So I would say these are some of the ways through which this can be done. Then the other thing could be the trend analysis. Now in terms of the trend as to how the numbers have been changing period on period.
Yeah. So one of the participants,
Called TDB board, QRB, I think.
QRB, yeah, QRB. So he or she wants to know if the advance tax amount in assets, assuming that it is 70% of the reported PBT, the advance tax. So what analytical procedures can be performed to check whether, they want to know whether it makes sense or not.
See, as around the advanced tax, I'm not sure as to why they want to specifically highlight on this advanced tax, because when it comes to the final set of financial statements, I would say it will all come down to the overall tax which may have been paid by the company vis-a-vis the provision which could be there in the financial statement. So let's suppose now this can again be looked at. So there could be a procedure wherein this tax has been computed. So what is the provision of tax which has been there vis-a-vis this percentage of advance tax, okay, wherein you can always check whether this percentage is 100% or not. Now this will not really be, I would say, used in the context of advance tax. I would say this can always be used in the context of tax rate, wherein a very commonly applied audit procedure happens to be the effective tax rate, which can always be compared year on year or period, and which happens to be a very, very important procedure as around the audit, and which is also required to be disclosed in detail in the financial statements. But if you just want to specifically look at this advanced tax, I would say it will be more about the test or substantive test which will go beyond the analytical procedures in that particular case.
Perhaps in some cases where this amount is huge, one may be able to look at like the revenue has increased in a big way. Imagine, but the advance tax and TDS is a very small number. So maybe that gives an indication: is the revenue number real, or is it something like some fictitious transactions have been put in? Or the other could be, as we say, risk of material misstatement, either due to error or fraud. So the error could be like, if you are not paid advance tax, genuinely they may not have paid advance tax, but whether the liability for late payment interest will be a big amount, so whether that has been accrued rightly or not. I thought probably these two contexts maybe one could do this comparison which you mentioned about this advance tax and the the revenue. Instead of going to the PBT, one can look at that, and there might be management maybe having explanations that although revenue has gone up because I have got so much of a the sort of a deferred tax or the unwinding, etc. So that's why my liability to pay tax is going to be less That's why it is the lower advanced tax. So it's more one can say that a probe to further analysis of why this the trend is not in sync actually. Yeah.
Yeah,
Right.
one more on the inventory front. What all substantive procedures can an auditor perform to check inventory in case of a real estate company?
Okay, so I think his query is more around the substantive procedures and not really limited to the analytical procedures. Yeah, so in case of inventory, I would say the most important procedure happens to be the physical verification. Yeah, so that is not really limited to real estate or any other industry. So physical verification is is very important, particularly in the context of this assertion around the existence. Then, like we discussed, as around the inventory, the other aspect becomes important in the context of its valuation. Yeah, because inventory is going to have a direct impact on the profitability. So now, as around this valuation, what have been the cost components which are forming parts? So now, one is that you will want to do a purchase testing, okay, wherein you will look at some of the transactions on a sample basis. You will look at some of these top vendors from which you have been making the purchases. But other than that, some of the cost components which have been moving into that composition of the inventory is also required to be looked at. Yeah, so now there's a complete valuation file which you will obtain from the client, wherein he will provide the complete computation of that particular inventory in terms of its cost. And in case of a real estate company, depending on the projects, okay, so for various projects there will be different project cost sheets. Yeah, so all of those project cost sheets are required to be looked at. So again, one will have to just choose as to which projects are larger one, which are the critical one, because in case the projects are many, so you are not going to check each and every project or each and every cost sheet. So you'll be looking at again on a sample basis in terms of its testing.
Wonderful. So we also have with us Mr. Kulkarni, who is a senior consultant. Mr. Kulkarni, your perspective on the importance of analytical review and also documentation thereof, as we emphasize in our webinar series, the importance of documenting the audit work done. Your perspective, please.
Thank you. Very, very right question you asked, Shyamji. And see, as for the first, this documentation is concerned, like earlier, Achalji also started when he actually showed us that good example of Excel sheet and how it need to be documented. And he also mentioned that many times the auditor do it, but they don't, keep evidence of that. So in the last couple of decades, what has happened is the audit professional standards have got codified and have become part of the law now. And yes, why they became all there? This is obviously the environment, the business environment, etc., has also become quite complex, and the expectation from the stakeholders of users of financial statements from the auditors, gatekeepers of the high quality financial reporting framework has increased. They rely a lot on that. And in that context, that's how these standards have become part of the law, and the required professional standards have also evolved over a period of time. They have become more prescriptive nowadays. Like in the earlier or conference, etc., you must have seen. It's no longer the world of extremes, like either principles or rule-based world. You need to have comply with both these requirements. Considering this, that's why there is a very specific standard SA 230, ISA 230, which requires you to actually maintain an extensive document, so that if a third party without having a knowledge of that, audit, they should be able to understand what you have done, what kind of a work. And it is in the auditor's own interest actually to keep that. In the event if something goes wrong in future, if you have maintained good documentation and if you have performed those audit procedures in line with what is required from as per the professional standards, you will be able to definitely save yourself, protect yourself, and that is not only protect and help yourself, but it is also going to increase the confidence of the public at large in the audit profession itself.
Yeah, it must speak for itself.
It must speak for itself. You are absolutely right, and that's why you are this tagline which you are having this thinking audit, not ticking audit. That's also very, very important. The audit documentation should not also become just a checklist of some ticking of some checklist. From that perspective, I think it's very important. And next, in 1 second or so, I want to just bring in this analytical review procedures importance. Very rightly, Achilji brought in that it is throughout the audit process, it has its role. And sometimes it is quite easy, sometimes it could be a difficult process to do. And but it has a lot of importance. And especially one thing I will also mention you, if you are as per the follow the true spirit of the audit standards, the quality of this analytical review procedure, the evidence you gather and you satisfy, it will actually help you reduce the audit steps in the substantive audit procedures. Depending on this analytical procedure confidence you gave, is it a persuasive evidence or is it corroborative evidence or is it a minimal evidence? Depending on that, your sample sizes and others will need to change. So from that perspective, this is quite important. So with this, I thought, I hope I have explained the questions which you had.
No, that was wonderful.
Yeah.
Bringing in your perspective, throwing light on the importance of both analytical procedures and documentation thereof.
Yeah.
Well, this brings us to an opportunity to me to extend a lot of gratitudes to many I would say instrumental people who enabled this webinar. So at the outset, I would like to express my deep and sincere gratitude to our executive body, who gave us the go-ahead, who gave us the guidance for conduct of this webinar series, which fulfills the mandate of NAFRA's Rule 16 of advocating and capacity building and all such conduct of seminars and workshops. So I thank our honorable chairperson also for guiding us all the way in the conduct of this webinar series. A special thanks to our secretary. She has been involved right through the planning stages, and she's been wonderful contributing for the conduct of this webinar. And I would like to express my deepest gratitude to our distinguished speaker, CA Achal Jain. Mr. Jain, thank you very much for sparing your time and taking us through this important audit area with such consummate ease, I would say, and with wonderful practical examples. That was a wonderful session to go through. And we also appreciate and commend your commitment for sharing your expertise and your experience with all our esteemed participants. To all the participants, we from NAFRA extend a very big thanks to you for keenly participating in all of the NAFRA webinars, and your participation added value to the learning experiences. And special thanks to all those participants who raised relevant queries, which made the sessions more valuable in terms of takeaways and learnings. Thank you very much. So behind this workshop, again, this webinar, our technical team has been working, to put us through this webinar. So we thank our technical team also for their contribution and their efforts. So I have with me Mr. Vidyadhar Kulkarni, who has been instrumental And, I would say one of the main actors in putting up this webinar, right through the planning stages, and, the series of webinars, right? So today is our fourth webinar, and we also look forward to such webinars in the next financial years, for which, we are in the planning stages. So, Mr. Kulkarni, a big thank you to you
Welcome.
for the conduct of this webinar series, and we look forward to this continuous journey of learning and sharing for professional growth. Thank you all once again for joining us in this NAFRA webinar and making it a memorable and enriching experience. Thank you and good day.
Thank you, Vachal. Thank you,
Thank
everyone.
you so much.
Yeah.
Thank you so much, Shyamji. Thank you, Vidyadarji. And thanks to all the participants. Thanks so much.
Good day. Bye-bye.